Okay, in this video, I'm going to talk about tax planning and how it can go very wrong. Okay, so this is a court case that I want to go over. And whenever something gets to tax court, it has been through a lot of layers to get there. Okay, this is not just something the IRS kind of disagreed with. This is something the IRS very clearly disagreed with because this taxpayer, of course, got audited. And then what happens is it goes to appeals. Appeals is like, absolutely not. And then it goes to IRS counsel to negotiate, and they try to settle these cases. So then the fact that now it is in tax court tells us that they went through all of those layers, nobody settled with them, and they somehow thought they were going to get a more favorable result by going to tax court, which statistics prove that that is almost never the case. We almost always get a very bad result for taxpayers going to tax court. So let's go over it. This case really demonstrates some very key principles when it comes to tax planning. I'm going to do a very high level review here because this stuff can get very detailed and complicated, but I think it's helpful when you are figuring out, okay, well, I want a tax plan, and a lot of times you're being sold by a lot of different people and you don't know what to believe, what not to believe. So understanding some of those core principles that the IRS looks out for is really important. So I'm Jasmine DeLucci. I'm a tax attorney, CPA, and enrolled agent. Of course, I do tax planning for a lot of my clients, and I also see a lot of people doing some very bad tax planning with unlicensed individuals, with licensed individuals, whatever it is. And we're going to go through the things that I see, and they're really exemplified by this case. So this is a very recent tax court case. So it came out in 2023. It's a tax court memo. So what that means is this is old law. This is boring when it comes to tax court. They are just reiterating law. They're not coming up with anything new here. This is no new concepts. They're basically saying, okay, we've got the established law and now we're just applying it to the facts of this case. Okay, so like I said, very recent court case that came out. All right. So in this case, we've got several issues at hand, and I went ahead and highlighted them. So the issues at this case are whether the pension contribution for tax year 2014 is deductible. We've also got whether the S Corp can deduct marketing fees at issue and rent paid. So let's go over the significance of this because, again, the context of this is that this taxpayer paid $50,000 for a 183-page tax plan. And I see this all too common where when you think of 183 pages being produced, it is not because that professional sat down and wrote 183 pages of new material. It's because they probably used a software or some really standard stuff to print you a very fancy report so that you'd feel better about paying $50,000. Not that these strategies are necessarily better, right? It's not necessarily correlated. And so let me just go to show you this section. So this is how I know that, right? They're telling us, okay, they paid $50,000 for this income tax plan, which you would think $50,000, well, I must be getting the best tax plan ever. And of course, these guys used and implemented exactly what was in the plan and ended up with a very bad tax court result. So supposedly it was taking their tax rate from 37% to 9%. So high level, what was in this tax plan is a few main pieces. So one was switching a Schedule C to an S Corp, which can sometimes be very advantageous. Then what the tax plan proceeded to recommend was creating a C Corp that is going to market on behalf of the new S Corp. So you always want to be careful whenever someone's proposing a new entity and then the entire substance of it is related party transactions. Doesn't mean it's wrong, but it means there are some things you should start asking here. Are we doing this for any purpose other than tax? Right? Because tax can be an important purpose, but legally it cannot be the only purpose. And so where that goes back to is there any substance here? That is where this falls flat. So that entire C Corp gets disregarded as a sham transaction, and that carries from the IRS auditor all the way through to tax court and gets reaffirmed, which is, yeah, it's a sham. Like, what was it really doing? It's got this related party transaction, and there really wasn't any substance there after creating that C Corp. That was a huge part of the tax plan that just completely fell through. And of course, the reason they created that C Corp was to create additional deductions that are specifically can be allowed on C Corps. The other important part that fell through was, so they took one other part of this plan, and part of the reason I was actually researching and reading this case is the Augusta rule. So this is really common. I have another video on this as well with another court case specific on the Augusta rule. But people get a little too aggressive with this sometimes with lack of support. What this tax plan did was it utilized the Augusta rule and assumed that the per day rental rate was $2,500, and then of course proceeded to disclaim that assumption and say, even though we've assumed it's $2,500 a day, you need to check independent comps and basically do all the work that I probably should have done within a tax plan that I charged you $50,000 for. So that's what happened. So that's where this professional was actually pretty well protected by all of the caveats that he put throughout the entire thing, but basically recommended something and then undercut it with a bunch of caveats that made the plan not implementable. And so that's what ended up happening, where they used the exact number that was assumed in the plan and that the tax savings projections were literally run off of, and then were just completely slaughtered by the tax court. And that deduction was obviously completely removed. So let's see what else here. We talked about the C Corp, we talked about the rent, those were huge. The marketing expenses, so that those marketing expenses that then they were paying this related party C Corp. An argument the IRS loves to use is that it's not ordinary necessary, right? So the reason we get to deduct business deductions in the first place is IRC 162, which says ordinary necessary business expenses. So those are, tax court does have a lot of history that shows that they're pretty broadly defined, but they're not infinite. So in a situation like this, let's see, they specifically talk about what they actually did was they used, within this case, what they did was here, we're not ordinary necessary, and they said, what they kept referencing in this case, which I thought was interesting, was they kept referencing the tax plan. And really what they're trying to say by that is, not only does this look wrong, it's like basically what they're saying, this looks wrong, and we don't see any business purpose for it. There's not really any other support for it. And the support we have is literally that it was done for tax purposes. So what they're essentially saying there is like, there's no substance and there's no reason for it. And if there's no substance, or this wasn't a necessary expense, then it's not ordinary necessary, right? It's kind of going back to the definitions. Of course, they go into more detail in legalese on how to explain this, but that's essentially what they're saying. Let's take a look at a little bit more, right? So they're saying there were no comps run. Again, you would think really expensive tax plan. I don't know why no comps were run, or at least suggested, or at least a reasonable number to estimate off of. $2,500 a day on its face, typically not going to be reasonable for the majority of houses. Most people, if they could rent it for $2,500 a day, they probably would rent it for $2,500 a day. So that's this case. I really liked this case for a few reasons. One of the main things I want to point out with this for tax planning, so if you're looking for someone to tax plan for you, it's not like this entire tax plan didn't make sense. It's like tax planning is not just the idea. And I think that's where maybe there's this notion that tax planning is coming up with the innovative, crazy, new idea where we like dive into the tax code and come up with something super unique. I mean, typically that's not the hard part. The hard part about tax planning is getting you 100% of the way there. So it's, okay, yeah, there's different ways we could go with this, which one makes the most sense, but then it's not just let's figure out what makes the most sense. It's taking you to the finish line. And what you can see from this case is, I always view it like a bridge, right? Where it's like we create the idea, we create the tax plan, But I mean, if you can't like get over to the implementation, you don't bridge over to it, and that doesn't happen, then like what was the point? So here, what ended up happening, and what's really, really common with tax planning, one person comes up with cool, interesting, great idea, doesn't want to implement it because that's hard work, and who wants to do that? And then the person who's implementing it, probably a CPA, which was the case here, doesn't take responsibility for the tax plan. They may say, okay, yeah, I'll implement it, but they say, well, I'll just plug in whatever you give me because, I didn't get paid for the tax plan. I'm not going to evaluate how good it is or whatnot, so we'll just plug that stuff in that you're handing me. And no one really takes responsibility on either end. That's where, in general, I would say if you're going to do a tax plan, I would typically have that same person implement it. If they're not doing any implementation, which basically means they're not doing any tax returns, I think there's some questions to be asked there. I think you're losing some of the value when you don't have those in sync with each other. So that's really what happened here. They didn't take responsibility. Nobody took responsibility for that important part in the middle. Things like, okay, let's get some fair market value comps. Let's make sure we actually do some of this additional legwork to make sure it's implemented properly. And that's where all of this fell flat. They didn't have the comps, they didn't have the support, they didn't have the documentation for the marketing fees. All of these things were cool ideas, but hey, where's the piece of paper that we sign, that we implement, that we make sure then is congruent with the tax return? So I hope that was helpful. If you're looking at tax planning, it's always important to do, but I think being careful about how you do it. I think it's very easy to kind of listen to certain people talk big picture and how they said they're just going to like wipe out my tax. It's going to be amazing. But I think especially whenever that is the result, asking some more questions, really understanding and kind of using your gut and as a gauge, okay, what licenses do they have? How well are they explaining this to me? Do they care? Are they going to implement it themselves? I think when there's a tax plan that someone's going to implement themselves, they're really taking on the responsibility there more than if they're not willing to file the returns for it. So just some of the things to look out for. Of course, we do tax planning, so if you would like to talk with me, I would love to speak with you. You can book a call at the link below in the description.